What's up, apes? Welcome back to the 𝗪𝗲𝗄𝗀𝗀 daily podcast slash video stream of the day. Thank you all for joining us once again on this beautiful Wednesday, August 7th, 2024. It is currently 7:13 p.m. and we have a lot to talk about in today's edition. We're going to try to keep it under the length of your average sitcom here, so let's just go ahead and get right into it. Very ugly day for the WSO Alpha team. Now, the new analysts that I hired on Tuesday after firing everybody in existence on Monday, they're doing a little bit of a better job, and damn it, they shit the bed once again on Wednesday. We were down about 1.2%, 120 basis points for the finance virgin loser nerds out there, as we were brought down most heavily by Airbnb with a loss of 13.87% for the session. Disney, Tesla, Dollar General, Builders, First Source were other kind of big detractors. Make sure to go ahead and subscribe to WSO Alpha if you want to get ahead of the whole portfolio. We have outperformed since inception. 2024 has been a rough year, and you can go ahead and check out the evidence for that on the WSO Alpha website. Meanwhile, so keep that in mind. We were down 120 bips. The NASDAQ was down 1.05% or 105 basis points. The S&P down 77 basis points, and the Russell down 118 basis points. So of the four major indices in the United States, the WSO Alpha portfolio unfortunately did lead the way lower. As the manager of that very important index, we're a little bit ashamed, but come in, trade with us, lose money alongside us. It's going to be a lot of fun. And we got some new offerings that are set to be coming soon, in addition to an equity research report that's going to be dropping at the end of this week. Okay, let's go ahead and continue moving before I start yapping and we never end up going anywhere. Let's get into some of the banana bits. We're limiting them to just 5 today. See you again so that I can stop yapping. Bank of Japan, they decided to pause their interest rate hiking cycle that they were about to enter because the Nikkei threw up for the worst day that a country's national index has maybe ever seen ever. It was down 12.25% in a single day earlier this week. Now, it roared back to life today because the Bank of Japan basically said, all right, maybe we won't blow up the entire economy. I guess that's a smart idea. So shout out to the BOJ for stopping the catastrophe that could have been in advance. J-POW could certainly learn a lesson from stopping things in advance. Nonetheless, 15 states saw population declines between 2020 and 2023. I'll give you one guess as to who led the list, and if you, it rhymes with 𝗪𝗏𝗡𝗪𝗏, and second place rhymes with 𝗪𝗎𝑢 York, but I certainly don't blame anybody whatsoever for leaving those two states. Personally, I was a little bit surprised because the state that I'm going to be moving to, that the 𝗪𝗏𝗄𝗀 Global Headquarters is moving to, also saw declines over the period, but much less than California and New York. Go ahead and check out all that data to see where all the new hotspots are in the United States. Meanwhile, future Treasury Secretary and current lowly CEO of JP Morgan, Mr. Jamie Dimon himself, is once again hyping up the odds for a recession, says he still sees recession on the horizon. Warner Bros. Discovery completely shit the bed. They're experiencing a recession of their own. They lost $10 billion in the last quarter, if you can somehow believe that. Most of it was due to write-downs of assets, but still, it's completely disgusting. David Zaslav, pick a worse CEO, right? Just load the company up with debt. Take your best brand in HBO and rebrand it to fucking Max. Stupid. Come on, give me a break. Nonetheless, just with stocks like this that are undergoing a huge turnaround, the way to do it is not to just pound yourself in debt and just buy other companies' debt in the meantime. Nonetheless, it does seem like that they are looking for partnerships. Now, Warner Bros. Was in conversation to add even more debt to get a piece of the Paramount Global sale and start to combine their streaming and content assets with Paramount Global and National Amusements more broadly. We'll see if they continue down that stretch because it seems like it's the only way this company's going to fucking survive for the next 3 or 4 years or so. Meanwhile, Warren Buffett and Berkshire Hathaway currently own more U.S. Treasury bills than the Federal Reserve by about $100 billion as well. They could affect quantitative tightening much more than the Federal Reserve. If Buffett was to start dumping treasury bills, the Fed might have to start buying just to keep things normal, just to stay the even. So we'll see. Warren Buffett really is the new JP Morgan. JP Morgan bailed out the United States government from 2 separate panics in 1903 and 1907. Warren Buffett is officially the new JP Morgan. Jamie Dimon probably isn't too happy about hearing that. Our daily poll of the day. Make sure to go ahead and check this because we're asking, during non-work related travel, which would you stay in? Would you stay in an Airbnb? Do you stay in a hotel, a Vrbo, or something else? Are you one of those fucking weirdos that checks up with a bunch of other, shirtless 20-somethings in a hostel or whatever the hell goes on in those godforsaken places? Let us know what your thoughts are in tomorrow's edition. By the way, more than 50% of you think that U.S. unemployment is going to hit 5% by the end of this year. I would assume that you also think an asteroid is going to hit us and, we're going to become the new dinosaurs for the next species of whoever, cockroach people that survive this eventual apocalypse. But nonetheless, go ahead and check out our poll for tomorrow. It's very relevant for us today because what we are talking about is directly related to leisure and hospitality. You guys have been saying that you tend to prefer when we do when we break down multiple different companies' earnings reports in short order rather than doing a deep dive into one single one. And we had the opportunity to do that today with a big sector of the U.S. economy being the travel and leisure sector. We have recent earnings reports from Airbnb, Marriott, and Hilton. So Marriott and Hilton, these are two of the largest publicly traded hotel chain operators in the United States, and Airbnb is Airbnb. If you are watching this video, you 100% know what Airbnb is, so I'm not going to explain that. But really, Airbnb, in case you don't know, it's basically the only company in the world that fucks you over and robs you more than the IRS does with all of their hidden fees and bullshit cleaning fees, even though they get pissed and leave you a bad review if you don't clean before you leave. The stock was down faster than a Boeing plane on Wednesday because earnings weren't great. They weren't terrible either, but the stock absolutely plummeted, once again showcasing a very brittle valuation. So let's go ahead and get into some of these numbers. So going back to the start of the pandemic, besides the federal government becoming even more bureaucratic and useless than it already is, buying job growth by just simply hiring more employees, another sector that's done a phenomenal job in growing employment is the hospitality and leisure section, or aka leisure and hospitality, as the Bureau of Labor Statistics likes to call it. And so we break that down in just a quick second. This isn't the fucking chart that I was supposed to be showing to you guys right now. Let me go ahead and get the correct chart pulled up right here. Hopefully we can pause this a little bit. Okay, because this is going to be important because it kind of shows why that this is important to the economy as a whole, and I'm not just kind of talking my book when it comes to the WSO Alpha portfolio. So what you are seeing in this chart that I'm actively creating and pulling up onto our screen here just shows the job growth over the past 2 decades. So this is very long term. You'll see it's basically flatlined because it is a relatively normalized process, but what we're seeing here is the job growth among different sectors of employment in the United States. This red orangey line right there is government jobs. This line that you absolutely cannot see on the video, there is a line right here. It's just fucking yellow because of course that's the line that I want to talk about. And then a couple other sectors down below to show how huge leisure and hospitality is. The demand for these jobs has been insane as well because since the pandemic period, obviously the travel boom is a very well covered thing. We all know what's going on there. The travel is absolutely exploding. The TSA is processing more passengers than they ever have in their entire history. And a lot of this is due to just that unmet demand from being left at home and then kind of the realization of hey, maybe I should have fun with my life if there's going to be another fucking pandemic that shows up. Once again, maybe I should get some actual experiences that I can think about and remember while I'm trapped in at home. So that has been driving this outperformance for quite a while in travel and leisure stocks, and especially contributing to their employment growth. The demand for travel and leisure employees is also running up it's contributed to faster wage growth in that sector than they've seen historically. That has since pulled back, so no real inflation risks anymore going forward. But let's go ahead and talk about these companies and see if all of that hiring was actually worth it. So for Airbnb, starting from a top-line perspective, it certainly does seem like it was worth it, but let's break it down a little bit before we get into this. What you're seeing right here is Airbnb's quarterly revenue growth. We saw 11% year-over-year growth last year, well, in the second quarter of this year, to $2.748 billion. So that's $2.748 billion. Once again, that's 11% growth. It might sound good on paper, but it's actually the lowest Q2 quarterly growth that the company has ever seen. So a big slowdown in revenue growth in the second quarter. Usually Q2, it's not a huge quarter for Airbnb, but it's the start of the summer, so it's important because it signals what's to come in the ever-important Q3 earnings period. So the company's guidance was fairly decent. Now, it did come in below where analysts were expecting it to, so that was a big reason for the sell-off. But the fundamental data that Airbnb reported included earnings of 86 cents per share against expectations for 92 cents per share, so they missed by 6.5%, again contributing to that downside. So what was actually causing this? Well, if we go ahead and take a look, gross bookings value increased by 11% to $21.2 billion. That's a total amount of money that went through the Airbnb platform between March and June, or for that second quarter, really April 1st and the end of June. That is their total amount of money. So what we're seeing right here is Airbnb is doing a weaker job of monetizing that gross booking value. So they reported record Q2 nights and experience bookings of 125.1 million. So you're at record bookings all time. You're at record gross booking value. So the number of bookings are at record highs. The dollar amount of those bookings is at record highs, but your revenue is growing slow and slower than it ever has in your entire history. That's kind of a signal that you're not monetizing as well as you used to. Combined with the weaker guidance, it's a clear signal that they're not monetizing as effectively as they used to. And that could be due to lower fees to keep prices down, to keep volume maintained, because everybody knows that getting an Airbnb is extremely expensive these days. It kind of goes against the entire value proposition of the company. But nonetheless, that is what they're seeing. Brian Chesky, the CEO of Airbnb, did come out on Bloomberg on Wednesday morning. The stock was down 16.6%. And he said, quote, "I'm confident now is a good time to buy." To be fair, you would be very hard-pressed to find a CEO that would say the opposite of that sentiment. So take that with an enormous grain of salt, but that's exactly what we saw with Airbnb. With Marriott, the story was mostly similar. Weaker monetization seems to be the problem plaguing the leisure and hospitality industry. So Marriott, this is the largest hotel chain in the United States. They posted revenue of $6.44 billion, missing estimates for $6.49 billion. EPS of $2.50 per share, just barely beat out estimates for $2.49 per share. So the stock was down about 5.5% since reporting on July 31st. The biggest problem that Marriott is seeing is expressed in this chart right here. So what are we talking about? A couple of acronyms to explain. Marriott reports its business units in a couple of different segments. You can break it down geographically, by brands, whatever you want to do. We went with brands and we broke it down how they do by considering luxury, premium, and select properties. Luxury, think Ritz-Carlton. Premium, think like, I'm totally going to blank on this. I think JW Marriott may have been. That might have been a luxury hotel as well. And then the select brand is like the fucking Residence Inn and stuff like that. The hotels that I usually stay at. That's going to be in the select brand of Marriott right there. So what we're seeing in these bars right here, the dark blue is called RevPAR. So this is revenue per available room. The lighter blue, this is called occupancy, and this royal blue is the average daily rate. So average daily rate combined with occupancy gives you the revenue per available room. So that's what we're seeing right here is the equation formed together. All you have to do is basically add these up. And so what we're seeing is that the luxury segment is experiencing the slowest growth in its revenue per available room. The premium segment is going strong, and the select segment is basically in line with its historical trend. So what does that tell us? Consumers are no longer accepting these high-priced rooms. They don't care much about that luxury side anymore. They just want to go, and it seems like a lot of those would-be luxury customers are moving down to the premium side of things. Now, I don't think this is necessarily like the wealthy people in society saying like, all right, I got to cut back, but it could be high-income earners, like Henrys, if you will, like doctors, lawyers, shit like that, that would stay in a luxury hotel if they wanted to. But, given that macro uncertainties plaguing the economy right now, they may have bumped down to just a premium hotel for the time being. And we're seeing a very similar story over at Hilton. So with Hilton, they break it down a little bit differently. We did go by geographic segment with Hilton because it's basically the exact same business as Marriott, and it gives you both of those two perspectives. They're seeing a lot of strength, especially in occupancy in the Middle East and Africa. They're seeing their highest ADR growth in the Middle East and Africa as well, and the highest overall RevPAR growth in Middle East and Africa as well as Europe. Now, where they're seeing particular weakness, however, is in the Asia-Pacific region. It was a very similar story at Marriott. As bad as getting people to pay up for hotel rooms has been in the United States, doing so in China has been even harder in recent months. So both Hilton and Marriott are experiencing very similar trends. Once again, that's lower pricing and weakness out of China. Airbnb, lower pricing, worse monetization once again. This is another image of exactly what was going on with Hilton. Hilton fell a little bit less than Marriott and Airbnb did because the company, although the unit economics were basically on par with Marriott, they opened a bunch of new rooms during the quarter. So that made the top line growth look a little bit better than it otherwise was. And they also have a record pipeline of 508,300 rooms that they're ready to build. So it's looking good in terms of their future prospects, even though the current quarter was kind of a sham for Hilton. Nonetheless, that's our big takeaway for checking out the leisure and hospitality market. Just comes down to the fact that consumers are no longer leisuring as hard as they had been in the post-COVID period. They're still going on plenty of trips, but they're staying in cheaper rooms. They're being a little bit more frugal about the trips that they're deciding to go on. And Overall, that's not going to completely fuck the leisure and hospitality industry, but what it does signal is, once again, that same idea of lower discretionary consumer spending going forward. That can be a bad sign for the economy. Another fear that we had was, if it slowed too much, are these hotel companies going to start laying off employees en masse, and is that going to contribute to rising unemployment? Probably not from our analysis. I mean, you can't be exact about any of this, but it wouldn't necessarily make sense to do so just because consumers are shifting their preferences to lower end travel amenities. What would make sense is to slow wage growth, and that's exactly what we want in this fight against inflation. So it's looking good. It's a slowdown. Once again, it's not bad, but it is worsening. And that's basically the story of the U.S. economy right now, represented in the leisure and hospitality segment. Moving into some of our what's right, what's rotten stock movers of the day. First and foremost, we have Upstart Holdings. The stock was up 38.9% for the session on, I was going to say killer earnings, but the earnings were kind of dog shit. Like, revenue fell 6% for the year. They still lost 17 cents per share, but that was a lot better than the 39-cent per share loss that they were expected to receive. This is a company that uses artificial intelligence and weird metrics like education and shit like that to decide creditworthiness of their borrowers. So that business model is going well. It hasn't really been part of the AI hype cycle just yet because it's still kind of reeling from the COVID cycle. It was one of the biggest names back then. It was the name behind the funniest CNBC clip of all time, where the guy has no idea what Upstart does. He's talking about how great of a company it is and how much it's contributed to the portfolio's growth. And then the CNBC host goes, "Oh yeah, so what do they do, by the way?" And he goes, "I think we're having connection issues." Like, that's usually, that was the same thing that I did in college when my teachers would ask me to, come and take an exam or pass in my homework or something like that. It was on Zoom. Perfect time to be going to college. I could just be like, "What's that? I didn't quite catch that." So I'm glad to see he took a page out of that playbook. But once again, it's looking good in the lending market overall, and we're going to talk about why exactly that should hold up well going forward with our thought banana piece of the day in the Sluice report. Moving on to our next what's right mover, we have Shopify up 18% for the session. You would think they were pregnant with how huge the bump in subscription revenue was in the second quarter. Absolutely huge bump of about 27%. Total jump in subscription revenue. That's basically pure margin for the company, at least after the first month that they signed that subscription. That contributed to 25% total sales growth for the quarter, eking out a beat of 0.2%. So not a huge beat, but definitely a beat nonetheless. Earnings did beat by a huge amount of 30%. So it's looking very good for Shopify in their e-commerce platform. This makes sense. Companies are going to be investing more into the platforms that actually deliver value. And what delivers value? E-commerce. Absolutely. Much more so than, pouring money into Mark Zuckerberg's pocket by continuing to spend on marketing and, outlaying cash for those ad dollars. Shopify isn't actually like business essential. It's a business essential expense for a lot of these digital companies that use the online platform as their primary retail footprint. Like, I'm pretty sure Allbirds uses Shopify, and like a lot of big companies nonetheless. This is a key business essential area. So obviously they're going to keep investing in that. 2020 hindsight makes that obvious, but still, nonetheless, not exactly shocked to see that Shopify is doing well as macro uncertainty increases and companies are looking to cut back and save for the future. Okay, moving into what's rotten for the session, we have Supermicro Computers down 20.2% for the day. Very much like a friend that says he can drive stick and then rolls into the first intersection he sees. Supermicro had a lot to live up to, and they failed miserably. It was a very tough time. I don't want to say they failed miserably because the results were pretty good, but compared to what the market was expecting, it was completely nothing. I think this is a great sign that you're in a bubble when you're reporting 78% EPS growth and 100% revenue growth, but you still miss expectations. The market still expects more from you. That just shows how much growth expectations have been baked into the stock's valuation over the past 2 years or so. They did give solid revenue guidance for 2025. It came in well above estimates, and they also announced a 10-for-1 stock split, but the market isn't buying that bullshit of a stock split contributing to outperformance anymore. Maybe retail investors are getting smart, or maybe we're just too poor to pay attention anymore. Okay, moving on down into our last stock mover of the day, a little company you guys may have heard of before called Disney. The stock was down 4.4% for the session, hating all over the WSO Alpha portfolio along with Airbnb. Now, it was like the shoe was on the other foot for this quarter because the parks business was a drag. Disney's parks and experiences business contributed to had a 3.3% decline in its segmental operating income, while Disney's streaming unit, which, over the past couple of quarters loses billions and billions of dollars every single quarter, actually became profitable in the third quarter of 2024. This is Disney's third quarter. They have a tough time counting. Streaming became profitable. It was only $47 million, but still we're moving in the right direction. That includes all Disney Plus, Hulu, as well as ESPN Plus. Overall net income came in at $2.62 billion. They saw a 3.7% increase in revenue for the quarter as well compared to last year. Now, Disney, for the same quarter last year, they lost about $460 million. So they're hyped about this $2.62 billion net income. Investors weren't too hyped because, again, the parks business is kind of the engine of Disney. It's very profitable. It's a very lucrative business for them. So, investors are kind of souring on that, especially given the fact that, very similar to what we were talking about with the leisure and hospitality stuff. If consumers are looking for cheaper vacations, Disney is definitely not the place to go. Okay, moving on down into our thought banana piece of the day. We're talking about the sluice report and how things are getting just a little bit sluicer. So, unfortunately, in recent months, I have learned how difficult it is to actually apply for a sizable loan like a mortgage and all the hoops that you have to jump through right there. I'm going to be going through this very in-depthly, but in order to do it in an entertaining way and not lose my house or have my interest rate get tripled, I'm going to wait until I'm actually moved in before I start yapping about all that stuff, because who knows what they can do to me beforehand. It was hard enough to even find a house and get an offer accepted, so let's not kill the deal at the last second. The Senior Loan Officer Opinion Survey, that's what we're talking about with the sluice report. Basically, the Federal Reserve says, hey, you tightening standards? Are you loosening standards? Are you seeing increased demand or decreased demand for all these different types of credit? There's basically three that we want to focus on here today. And the first one includes consumer demand of all kinds. So this is consumer demand for lines of credit in general. What you see here, this black line is how they used to do it, kind of all amalgamated into one. Now they have three different segments, including credit card, auto, and other consumer. What we're seeing is that for the first time since 2022, demand for credit via credit cards is actually increasing once again. So when we're below the zero line here, that means that it's decreasing. And when it's moving lower, the amount that it's decreasing by is increasing. But when we're below zero and we're moving higher, as we have been since about late 2022, that means it's decreasing by less in any given month. And so for the first time since 2022, credit cards are no longer decreasing less. They are simply increasing. Now, it's at a very slow rate, but the demand is there from consumers. Meanwhile, the way that senior loan officers have responded to this is by tightening credit standards throughout basically the exact same time period. But what we saw during the July survey was a continued downtick in lending standards. Now, loan officers have a tough equation on their hand. In order to continue to grow their businesses, make their bonus, and make their boss happy, they do have to continue to increase originations, but you don't want to increase originations like out of nowhere. And especially as some of these senior loan officers pointed out in the survey itself, increased macro uncertainty causes them to want to tighten lending standards. But to continue the growth, I mean, there's kind of that beautiful balance between wanting to continue to grow, but wanting to actually have a financially responsible business. This doesn't smell like 2008 at all whatsoever. And it really isn't, especially when we factor in mortgage demand. So what we're seeing right here, similar to what they do with consumer credit, is they started by amalgamating it up until about 2007, very ironically. And then they broke it down between prime, non-traditional, and subprime mortgages. All of them are still below zero. They are still decreasing on a monthly basis. Demand continues to lower, but it's doing so at a slower pace going forward. And especially with rate cuts on the horizon, I would expect this to officially go back above zero over the next couple of months. And that kind of brings us into our final point, a big takeaway, because as rate cuts approach, it seems like consumers are starting to get a little bit more used to them. They're kind of warmed up and just accepting their fate, much like I did in buying the house at literally the worst time possible. I'm pretty sure the exact date that we got the accepted offer was the absolute peak in the Redfin Home Price Index. We'll see once we get the print for the month of August if that continues to uptick, but we'll find out later on. Yeah, that's basically our big takeaway for the day. Can we expect default rates to increase? Will mortgage origination explode following a Fed cut? Let's go ahead and finish it up with a quote of the day from one of the CEOs of one of the companies that we talked about. We already gave you a 𝗪𝗦𝗢 𝗣𝗀𝗃 quote, and we are doing it again to finish up the session. He said, Build something 100 people love, not something 1 million people kind of like. That's Mr. CEO Brian Chesky for you right there. We still went way too long on the session here today. Patrick's going to be, I'm pissed at myself. Fucking, I mean, Jesus Christ, I got to chill out with all the yapping going on here. But thank you guys for tuning in once again to the Daily Peels Daily Podcast / video of the day. Make sure to like, comment, subscribe, do anything to boost us in the algorithm and respond to our daily poll tomorrow. Otherwise, happy investing, happy trading, and we'll see you tomorrow. Bye now.